The stock doesn't know you own it. You may have all these feelings about the stock. The stock has no feelings about you.
When you are searching for a way to bid farewell to your stocks, you must always take a few important considerations. You don't want to leave too early and miss out, but you don't want to be the last on the competitive floor. Stock games are pretty tough to understand, so today I will discuss how to decide when to sell a stock in this video. Focus on long-term value. Let's kick things off by talking about the golden rule of knowing when to sell a stock, focusing on long-term value. When you buy a car, you are not just thinking about how shiny it looks today, right? You are also considering how reliable it'll be in the long run. Investing in stocks is a lot like that. You are not just looking at the momentary buzz, but gauging the company's potential to grow and thrive over time. Warren Buffett, the grandmaster of long-term investing, puts it best. Our favorite holding period is forever.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time.
That's like him saying, "I'm not here for a fling. I'm here for a meaningful relationship." When you're invested for the long haul, you're less likely to be swayed by short-term market noise or fads. Suppose we talk about an example here of you buying a cake. Would you pay a hefty price for a slice if you knew it would taste like cardboard in a day? Of course not. Similarly, when you're investing in stocks, you're not just looking at the initial price. You're assessing whether the company can continue to deliver sweet returns over time. So there you have it. Embracing the long game is the first secret to knowing when to sell a stock. Whether you're sipping lemonade or crunching numbers, remember that focusing on long-term value is like choosing the scenic route over the quick detour. Stick around for the journey, and the rewards might just surprise you in the end. Understanding the business. Understanding a business is important when it comes down to selling a stock. We are talking about deciphering the very DNA of a company to know when it's time to buy and when it's time to bid farewell. It's just like you being at a fancy dress party, and you're the only one who knows the theme. Understanding a business is like that. It's not just about knowing what the company sells, it's about grasping how it operates, what makes it tick, and how it's poised to conquer the world, or not.
You're not buying a stock, you're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
Warren Buffett's partner in investing crime, Charlie Munger, famously said, "Invert, always invert." It's like he's the Sherlock Holmes of finance, urging us to look at things from all angles. So, when assessing a company, don't just focus on its strengths. Flip it and study its weaknesses too. Start with the basics. What's their core product or service? Who's running the show? What's their competitive edge? And most importantly, how do they make money? It's like putting together a puzzle. The more pieces you have, the clearer the picture becomes. So, when deciding when to sell a stock, remember that understanding the business is like reading between the lines of a thrilling mystery novel. Embrace your inner detective, channel your inner Charlie Munger, and ask the tough questions. Because, just like a brilliant plot twist, the insights you uncover might be the key to making informed and strategic decisions in the market. Avoid emotional decisions. Let's discuss a game changer regarding knowing when to sell a stock. Avoiding those pesky emotional decisions. It's like riding a roller coaster with your heart in your throat. Exhilarating, but not the best time to make life-altering choices. Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." Emotional decisions are the enemy of patience. They might lead you to sell when everyone else is selling. And guess what? That's often when the real bargains are born. Here's the kicker. Think about when you bought something because everyone else was buying it, and then realize it wasn't your style. Emotional decisions in the stock market can be a bit like that trendy fashion piece that gathers dust in your closet. When you follow the herd without assessing the facts, you might end up with a portfolio full of meh.
You're emotional about investments, you're not going to do well. I mean, facts are facts and reason is reason, and you can develop all these attachments or angers or whatever about your stock.
When the stock market roller coaster starts looping and diving, Remember that avoiding emotional decisions is like taking the driver's seat rather than being a passenger. Keep your cool, stick to your strategy, and don't let emotions steer your financial ship off course. Like a true captain, you'll navigate through the storm and emerge with a solid portfolio set for smoother sailing. Reassessment of investment thesis. Okay, now let's jump into a chapter about reassessing your investment thesis. In plain English, it's like checking if the story you believed in is still playing out the way you thought. Imagine binge watching your favorite TV show and suddenly realizing the plot turned wild. Reassessing your investment thesis is like being the director of your financial blockbuster. You need to keep tabs on how the plot unfolds. Remember Blockbuster? Once upon a time, it was the king of movie rentals, but then this little thing called Netflix happened. Blockbuster failed to reassess its strategy, and you know how that story ended. Warren Buffett has a great saying, "When the tide goes out, you see who's been swimming naked." It's like he's reminding us that reassessing your investment thesis is crucial when the market tides change. Companies evolve, industries shift, and sometimes your original investment thesis might need a tune-up. So, as you journey through the land of investments, remember that reassessing your investment thesis is like being the captain of a ship that adjusts its course with the changing winds. Keep your eyes on the horizon, stay flexible, and you'll be ready to rewrite your financial success story when the story shifts. Opportunity cost consideration. Opportunity cost consideration is a concept that's as important in the investing world as choosing which path to take in a labyrinth. It's like deciding between spending a day at the amusement park or a day at the beach. Each choice comes with its own gains and losses. You are holding onto a stock treading water while other opportunities start making waves. Opportunity cost consideration is deciding whether to stay on that slow boat or jump onto a speedboat zooming ahead. And guess what? This concept isn't just about money. It's also about your time and energy. Think of it like this. You are deciding whether to binge watch a TV show or finally start that novel you have been eyeing. This factor is all about acknowledging that the hours you spend watching TV could be hours spent reading, learning, or even starting a side hustle. Whenever you move through the landscape of opportunity cost, remember that it's like a compass guiding you toward the path that aligns best with your goals and values. Don't just chase after every shiny thing. Consider what you might be giving up. It's not just about the price you pay, it's about the rewards you reap from your choices. Valuation and overvaluation.
Opportunity costs. Many people have heard about opportunity costs when it comes to business and making business decisions, but there are opportunity costs involved in everything we plan to do. So it's really what you have to give up to do the thing you're doing. So right now, if you're watching me, you are not doing something else.
Valuation and overvaluation are vital in determining when to sell a stock. You may spot a vintage comic book priced way above its market value if you are at a garage sale. Valuation is like checking if that price aligns with what the comic is worth. Similarly, in the stock market, valuation assesses whether a company's stock price aligns with its true value, considering factors like earnings, growth potential, and industry trends. On the flip side, overvaluation is like seeing that same comic book priced at an astronomical figure. It's a sign that someone's a bit too enthusiastic. When a stock becomes overvalued, its price exceeds its intrinsic value, which can lead to a correction down the road. Recognizing overvaluation is crucial for making informed decisions on when to exit an investment. So, when to sell? If your research and analysis indicate that a stock you own is overvalued, it might be a sign to consider selling. However, finding a solution isn't about timing the market perfectly. Instead, focus on a balanced approach. Periodically reassess the stock's valuation, stay informed about the company's performance, and align your decision with your long-term financial goals. Remember, it's not just about when to sell, it's about making rational choices that match your investment strategy. Market conditions versus business conditions. Understanding the interplay between market and business conditions is crucial when deciding when to sell a stock. Market conditions, like the weather, can be volatile and influenced by investor sentiment. They might inflate stock prices beyond their intrinsic worth, creating potential bubbles. On the flip side, Business conditions encompass a company's performance, growth potential, and industry dynamics, the real substance behind the stock. During frothy market conditions, stocks can become overvalued, detached from their business performance. This misalignment often leads to corrections, as seen in historical market bubbles. To make informed decisions, it's essential to assess both sides. If market conditions are euphoric, but business conditions are lackluster, it might be a cue to consider selling. To face such a situation, you have to strive for balance. Stay informed about a company's financial health, industry trends, and long-term prospects. Don't be swayed solely by market hype. Understanding the delicate dance between market and business conditions allows you to make more rational choices aligned with your investment goals.
Now we sell really when we think that when we're reevaluating the economic characteristics of the business. In other words, if you take don't want to name names, but take a stock we've sold of some sort. We probably had one view of the long-term competitive advantage of the company at the time we bought it.
Remember, successful selling isn't about timing the market perfectly. It's about navigating the crossroads of market and business conditions wisely. Lessons from mistakes. As we round off our journey of when to sell a stock, let's take a peek at the wisdom hidden in the shadows of mistakes. Every investor's closet holds a few skeletons. Stocks sold too early, too late, or for all the wrong reasons. It's like looking back at an outfit you regret wearing and realizing you've evolved in your style. Imagine selling a stock solely because its price took a temporary dip. Lesson learned. Knee-jerk reactions can lead to missed opportunities when the stock eventually rebounds. Or consider selling due to market noise rather than business fundamentals. Mistake noted. Market sentiment doesn't always reflect a company's true potential. Learn from others' mistakes so you don't repeat them. So, what's the takeaway? Analyze past errors, both your own and those of others, to enhance your decision-making. Before selling, assess why you're making the move. If it's based on lessons from mistakes, proceed with caution. If you have addressed the blunders, you are better equipped to sell smartly. You are crafting a resilient strategy to market storms by analyzing and learning from them. As you decide when to sell a stock, remember it's not about avoiding errors altogether. It's about using them to make wiser decisions and sculpt a financial journey that's uniquely yours. If these insights sparked a light bulb moment or two, don't keep them to yourself. Share this video with your friends, family, and fellow investors who are looking to master the art of when to sell a stock. Remember, a like and a subscription goes a long way in supporting my journey of financial wisdom. Stay tuned for more empowering content. Hit that subscribe button now.